We're kicking off today's coverage with a confluence of institutional forces that could define the near-term trajectory of U.S. monetary policy. A landmark Supreme Court ruling and a high-profile ECB conference are converging at precisely the moment Kevin Warsh steps into his role as Federal Reserve Chair. This isn't just political backdrop noise. These two events carry direct implications for how aggressively the Fed can act, how markets price rate expectations, and where the dollar lands. With equity indices showing weakness, investors are already showing signs of unease, and the real test for Warsh may be arriving faster than anyone anticipated. The setup here is unusually dense. A Supreme Court ruling with material implications for regulatory structure is arriving alongside an ECB conference expected to signal European monetary policy direction, and both land during the opening weeks of Warsh's Fed tenure. Meanwhile, the macro backdrop is already fragile. The S&P 500 is off 0.72%. The Nasdaq 100 is down 1.38%, and the 10-year Treasury yield is holding at 4.37%. The VIX is sitting at 18.41, down 2.54%, which tells you implied volatility is relatively subdued right now. But that calm could evaporate quickly depending on what these two institutions deliver. The dollar index, DXY, stands at 101.36, barely changed, as currency traders wait for clearer signals. The deeper story here is about Fed independence and institutional constraints arriving simultaneously from two directions. If the Supreme Court ruling expands regulatory authority or reshapes the administrative state in ways that constrain the Fed's operating latitude, Warsh inherits a legally redefined institution before he's even established his policy voice. On the ECB side, any signal of dovish divergence from Frankfurt forces a dollar repricing and puts the Fed in a politically uncomfortable spot. Does it follow global peers toward easing or hold the line? The 10-year yield at 4.37% is the fulcrum. A break above 4.40% would immediately signal that bond markets believe Warsh faces a tighter-for-longer constraint than his predecessor left him. The transmission is broad and sector-specific. Financials benefit most if regulatory uncertainty clears. Reduced compliance costs flow directly to earnings, and the financial sector becomes a primary beneficiary. SMH and rate-sensitive tech, housed inside the Nasdaq 100 face continued pressure if the yield curve stays elevated or steepens. Small caps are showing relative strength, suggesting some rotation away from megacap growth. On the safety side, gold futures at 4,078.70 are up 1.20%, and silver at 59.22 is up 1.49%. Precious metals are already acting as a hedge against this dual uncertainty. Long-term treasuries, the long treasury ETF, becomes the key rate cut expectations barometer. GDX, precious metals miners, catches a bid as gold strength builds. The single most important number to track is the 10-year Treasury yield at 4.37%. A sustained push above 4.40% would signal that bond vigilantes are pricing in tighter financial conditions under Warsh, bad for duration assets, bad for growth equities. S&P 500 support, near 7,290, is being tested right now with the S&P 500 already under pressure. The Nasdaq at 28,261 is the more vulnerable index, given its concentration in rate-sensitive tech. Watch DXY at 101.36 closely. A break lower following ECB dovish signals would confirm policy divergence is real and could provide a tailwind for commodities and export-oriented industrials. Gold holding above 4,078.70 acts as a real-time fear gauge. The VIX at 18.41 has room to reprice sharply if either event surprises. The bottom line is this. Kevin Warsh's credibility as Fed chair will be shaped in the next few sessions by forces largely outside his immediate control. If the Supreme Court ruling clears regulatory headwinds and the ECB leans dovish, the dollar weakens, equities recover, and Warsh gets breathing room to define his own policy path. If either event tightens financial conditions through increased regulatory burden or a hawkish Frankfurt surprise, defensive sectors, gold, and long-term treasuries become the immediate winners while the Nasdaq 100 and the S&P 500 absorb further downside. The 4.37% yield and 101.36 DXY are the two coordinates every macro trader should have on screen heading into next week. That's the full picture on the Fed and Warsh's opening institutional gauntlet. Coming up, a story that's been quietly reshaping the commodity complex and has traders rethinking one of the year's most crowded positions. Shifting now from our first story, we turn to a contrarian call coming out of Wall Street that has traders reconsidering beaten-down Chinese internet names. Citibank is telling clients to selectively accumulate Chinese internet stocks following a sharp valuation compression in the sector. This is a bold stance given the macro backdrop. The S&P 500 is down 0.72% on the session, while the Nasdaq 100 is underperforming sharply, off 1.38%. Meanwhile, gold futures are climbing, up 1.20%, signaling that defensive capital rotation is very much alive right now. Citibank's research desk has formally recommended selective accumulation across Chinese internet names, specifically calling out Alibaba Group Holding, JD.com, PDD, and NetEase as key targets, with the broader FXI shares China large-cap ETF serving as the sector proxy. The rationale is straightforward. Valuations have compressed dramatically enough that Citi sees asymmetric upside from current price levels. This is a contrarian posture relative to Wall Street consensus, which has remained largely defensive on China-exposed equities amid a combination of domestic regulatory uncertainty in Beijing and persistent geopolitical friction between Washington and Beijing weighing on risk appetite. The real driver behind Citi's call is valuation arithmetic. When regulatory crackdowns, macro slowdown fears, and geopolitical headline risk all compound simultaneously, multiples compress beyond what fundamentals alone justify. And that is precisely the environment China Internet has been navigating. The 10-year Treasury yield at 4.37% sets a high bar for any growth equities discounted cash flow, but Citi is essentially arguing that Chinese Internet names have already absorbed that discount, and then some. The risk-free rate anchor matters enormously here because it defines the floor at which emerging market technology equities become genuinely attractive relative to simply holding treasuries. The most direct beneficiaries of any sentiment reversal are FXI, which captures broad China large-cap exposure, and the individual ADRs. Alibaba Group holding in e-commerce and cloud, JD.com in logistics-driven retail, PDD in social commerce, and NetEase in gaming and online services. On the sector rotation side, technology and consumer discretionary with China exposure are the obvious plays. However, notice the divergence in today's tape. The Dow is showing relative strength while the Nasdaq 100 is off 1.38%, reflecting capital shifting away from growth-sensitive names into defensives. Silver futures and gold are both gaining, confirming that safe haven demand is not disappearing despite Citi's bullish framing. Traders should monitor FXI support levels as the first technical test of whether Citi's accumulation thesis attracts follow-through buying. On the macro side, the 5-year Treasury yield at 4.13% is critical for Chinese corporate refinancing costs. Any move higher pressures balance sheets for heavily leveraged platform companies. The VIX at 18.41, down 2.54% today, suggests the options market is relatively complacent, which cuts both ways. It keeps hedging costs low for those building positions, but it also means the market is not pricing significant tail risk from a potential U.S.-China policy escalation or a surprise regulatory announcement out of Beijing that could trigger a sharp repricing. Citi's call represents a credible contrarian entry point for investors willing to accept China policy and U.S.-China geopolitical tail risk in exchange for exposure to deeply discounted internet franchises. But with the 10-year yield at 4.37% and gold trading higher, the macro environment is still signaling caution, not euphoria. Position sizing and catalyst awareness, particularly around any regulatory signals from Beijing or shifts in U.S. trade posture, will determine whether this trade works or becomes a value trap. Those are the two stories that matter most this session. The full breakdown is complete. If this deep dive analysis helps you trade smarter, hit subscribe and tap the notification bell so you never miss a daily market breakdown. We cover the stories that move your portfolio every single session.